Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Stephanie Roth of Wolfe Research writing this. Data this week has been disappointing. The labour market has decelerated, but it's not clear it's getting worse. Stephanie joins us now for more. Steph, good morning.
Good morning.
Any signs of stabilisation?
Yeah, I mean, we saw ADP looks better than where it's been. Of course, we're all now focusing on Tier 3 data because that's all we have to focus on. The challenger numbers have spooked a lot of people, but I have to say that is based on headlines. And we knew that UPS, for example, that was a big driver of the warehousing number. That has happened throughout the course of this year, largely through attrition. We knew the Amazon number had come out. That was part of that, the October data. So our sense is that the labor market has decelerated. That's what we're picking up here, but it doesn't appear to be actually necessarily getting worse. And then the picture for the economy on a go-forward basis is actually pretty decent. We have likely tariff uncertainty is fading to some extent. We know that we kind of have a floor in terms of tariffs. We have financial conditions have eased. We have fiscal stimulus is going to have a supporting impact on the low-end consumer. So even though we're in a place where the economy is kind of sluggish, the factors are looking pretty decent for 2026.
You said something about the challenger job announcements or layoff planned cuts, and I think that it's really important, the idea that a bulk of this could come from UPS and Amazon, both of which were reported, and has to do with warehousing on the UPS side and artificial intelligence on the Amazon side. How much are we conflating a single name story with a broader market trend where AI is already taking people's jobs?
Yeah, I mean, I think that's the case to some extent. And the Amazon numbers aren't that large relative to the size of its workforce. So even though we've seen some of these layoff announcements that are tied to AI, some of this ends up coming out through attrition like the UPS. And it's not entirely clear that AI has really been taking that many jobs so far. Looking forward, it might be. But if you look at a correlation between AI usage by industry and the slowdown in payrolls growth, you don't see much of a correlation outside of tech, professional services, and then a little bit of finance. So it's not necessarily the explanatory story yet.
In the absence of non-farm payrolls data, a lot of people are thinking big, asking large questions, filling time with other things. I'm just wondering how much people are trying to understand the AI growth story and how much it's propping up and, frankly, masking the weakness that we're seeing in other pockets, particularly from, and we keep talking about fast casual restaurants just simply because that's the data that we have. But, you know, it sort of speaks to a really lopsided economy heavily weighted to the AI story.
So, I mean, I think that the K-shaped economy story is right, but it's not necessarily the bottom part of that K is getting that much worse. We're just hearing a lot of company announcements related to that, and we don't have any other data to the other side, which tends to capture the broader picture of the consumer. And then the AI story is driving a decent portion of growth this year. Our estimates are that it's nearly a quarter of the growth, if not maybe a tiny bit less than that. But it's certainly not half of the growth. And it is part of the economy. There are a lot of people who are employed and investing in CapEx, and that is a support for growth that is durable.
Stephanie, I want to pick up here on your point that the market has and investors have kind of moved past the tariff story. What if IEEPA, though, does get struck down by the Supreme Court?
Then they'll recreate it. So what we're really talking about here is about $100 billion windfall to companies, potentially, depending on how this all plays out in terms of tariff refunds they might be eligible to get. Otherwise, on a forward-looking basis, the administration is likely to recreate the tariff structure very similar to how it stands today, which is why the bond market doesn't necessarily have to react so significantly.
But it'll take a lot longer to recreate that structure using 232s, 301s. When would the hit be on consumers if they have to recreate that structure?
I don't know if it will end up being that big of a hit on consumers in the sense that companies have raised their prices. They're not going to lower their prices as a result. We're not going to see much volatility depending on how the tariff structure works. So companies have slowly moved their pricing mechanism higher. They know, especially if it ends up getting struck down, they know that it will largely be recreated. The administration will certainly communicate that, in which case the pricing effects will continue to kind of be the case, and then companies will maybe more slowly pass through the price increases. Our estimates suggest that about a little little above 60% of the tariffs that are implemented and expected have been absorbed by parts of the supply chain. So it's the exporter, the retailer, and the consumer. So we've already gone through a lot of it. There is certainly more to come, which is why we should see upward pressure on prices for the next 6 months.
Was October Chair Powell's last rate cut?
No, I think he'll probably do one more.
Yeah, just the one?
I think he'll do one more, and then we'll probably get an additional 1 to 2 beyond that.
You see a difference between the leadership once he's gone? We're going to have a more dovish Fed after May? Or do you think it's going to be just as conflicted, just as gridlocked?
Just as gridlocked. I think we'll see, of course, the chair may be dovish themselves, but that doesn't mean the committee is going to go alongside that. We've seen a committee that is certainly divided. That's been quite clear over the past couple of months. So our expectation is they're not going to really change policy that much as a result. And yes, they probably will want to cut a couple more times beyond that just to get to something that they think is closer to neutral. And the economy will probably be in a decent place throughout much of next year.
Stay with us. More Bloomberg surveillance coming up after this. Gardner of Stifel writes the following. Some Democrats will likely see Tuesday's election as a validation of their shutdown strategy. The chances of the shutdown lasting into next week and beyond have increased. Brian, welcome to the program. Are you suggesting that those wins are more relevant than the potential chaos across the country's airports?
In the minds of some Democrats, yes. I mean, not all Democrats. I don't think, Jonathan, that you can paint with too broad a brush. I think there are some more aggressive Democrats, some more firebrand type Democrats who see Tuesday's results as a validation of their strategy. And they think they have the wind at their back and they are going to double down and push for more. Then you do have some moderates who want a solution. And look, I think you can argue that Tuesday's election results gave us a split view of the Democratic Party nationally. The firebrands won in New York, but the more moderates won in Virginia and New Jersey. So there is a bit of a split among Democrats about what their strategy is going forward.
And in Virginia, the exit poll said that the shutdown was weighing on the workers, those individuals that went out to vote. Obviously, they house so many of these federal workers. Can you see Virginia senators signing up for a clean resolution?
It's a great question, Anne-Marie. I mean, because Virginia is, among one of the two states that's ground zero, along with Maryland, in terms of government workers. But the two Democratic senators have pretty much held strong. I haven't detected that they're breaking from the rest of the group yet and joining the more moderates who are pushing for a reopening. I may be missing something on that. But those are two people that I would look to very closely to see if there's going to be a break among Democrats, if there's going to be real progress in these talks. You would think that Senators Kaine and Warner would be front and center.
Would it just be enough as an off-ramp for the Democrats to get a vote, Senate Majority Leader Thune put a vote on the floor for the enhanced expiring health care subsidies, or do they actually need a plan to extend them? That's
the big question. I think it shows the split among the Democratic Party. I think for some centrists, they would be okay with it. But the firebrands for now are pressuring them not to give in on that. And so far, I think the louder voices in the party, the more aggressive voices in the party are winning out, in terms of party unity and keeping everybody on the same page. At some point, though, if we get into the weekend or next week and we have those airline delays, and the cuts in social safety net programs really start to get to the bone, maybe then you'll see a change in tactics and strategy among the Democrats. But I got to say, I mean, it's been impressive to watch them stay unified. Whether you agree with their policy or not, their sense of unity has been pretty impressive throughout this.
What's your sense about the reduction in flights that we are seeing right now and the mandate coming from the FAA? Do you think that this is actually a safety issue, or do you think this is trying to raise the pressure to get some sort of conclusion sooner?
Oh, I wouldn't be that cynical, Lisa. No, I mean, look, and I'm somebody who, my flight wasn't canceled last night, but I ran into a bunch of delays. So, I mean, I think travelers are really going to start to feel it. But there's politics going on here. Let's go back to Casablanca. Shocked that there's gambling going on. I'm shocked that there's politics going on here. I'm sure there is a level of safety. at work here, but there's a level of politics as well.
So you're not that cynical, but it could be true. Brian, I am curious. But I am curious. There was this move yesterday that I thought was pretty telling when Republican senators pushed back against President Trump. And after that breakfast, they signaled that they were not going to nuke the filibuster, akin to what he was looking for. How big of a deal is that?
In longer term, it's a big deal because it has ramifications for both parties going forward. In the short term, I think it's starting to signal that, and we have to read this in the context of Tuesday's results, that some Republicans are going to start to look in terms of self-preservation, and they're not going to be as locked up with the White House as they have been. And they probably are going to feel a little bit more looking longer term to what's in their best interest, not just what their relationship is like with the White House at any given moment.
Brian, have you got a hard out? Is there one on the calendar?
No, I mean, Jonathan, I could give you, Monday or Tuesday, but, I was so wrong at the beginning of the shutdown when I really thought it was going to be a shorter stalemate than it has proven to be. And I think, not just me, but talking to people up on the Hill, I think they've given up on trying to handicap this as well. I thought it, after Tuesday, I thought it would go into the weekend. I think maybe we get into early next week and there's an out, but who knows at this point? I think a lot of us have underestimated how long this would go on.
Stay with us. More Bloomberg surveillance coming up after this. Nadia Lovell of UBS Global Wealth Management writing, while elevated valuations continue to raise concerns and could lead to increased volatility, we believe that underlying fundamentals remain strong and consider market pullbacks as buying opportunities. Nadia joins us now for more. Nadia, good morning.
Good morning.
What happened to the year-end melt-up? Where did it go? What went wrong?
It's only been a week, Jonathan. We think that it's still there, right? Of course, investors are again confronted with this wall of worry. We have the government shutdown, we have concerns around AI spending, we have hawkish, rhetoric from the Fed, but that could cause some volatility in the near term, as we noted. But we do think that wall of worry will be climbed because the fundamentals are there. When you look at the earnings season, above expectations, even our elevated expectations for 10% EPS growth for the quarter, when it's all said and done, we could get something in the mid-teens. So we think that will continue to support the market once we get through this choppiness. And that's why we think that there's not going to be any sort of significant pullback, because we do think that, particularly on the institutional side, we'll step in and buy. I'm
with you. It tells you something about the market when you get a 3% move on tech stocks and the bears start popping champagne. They've had a tough year, particularly off the lows of April. Let's talk about the move into year-end and the subtle signs we're getting from the price action in response to earnings. Lisa was going through a range of equities that we've seen report earnings, decent earnings, and this market's pushed back. That's new. We haven't been seeing that over previous quarters. They've been rewarded for decent earnings. What's changed?
I think what's changed is that, the valuations, people are focused on the valuations. Also, you're seeing some weakness in tech, and that's causing some nervousness. And it's fair for, tech investors to start to say, where's the monetization of this? But realistically, it will take some time to get there. But I think you're starting to see evidence of that. If you look at the earnings season, particularly around cloud growth, right, that's where you're seeing the monetization. You've seen AWS printed 20% year-over-year growth, an acceleration of 200 basis points from the last quarter. You've seen a similar acceleration from Google, 34%. And then Microsoft also, 40% in terms of their Azure revenue growth. Ultimately, it's a supply constraint that's holding back even those high growth. So we do think that investors will come back, and reassess some of these fundamentals and realize that they actually have been quite strong, Jonathan.
You can dismiss the pullback that we've seen over the past week as just saying, okay, it's just been 1 week. That said, you have seen a shift where momentum and that whole trade has been unwinding. We've seen that in meme stocks. We've seen that with Bitcoin. We've seen that even on the peripheries of gold. We've seen that with a number of some non-profitable tech names that also got bid up. What do you think is behind that?
Look, reality is, did the market run too fast, too quickly in the last month, you can make that argument, yes. And so taking some off the table, it's a natural sort of course in terms of, a pullback. We haven't even gotten to 5%. And I think once you get to that 5 or 6 or even 7%, which we don't think you're going to get to, then you're going to see money start to come back into the market. So I think it's just sort of a reallocation and looking for those opportunities where you're particularly some on the lagger side, even in healthcare, I think that money will start to flow into that. And so it's taken a little bit off the table on some of the winners. And then I think into year end, you start to see some of the laggers get a bit.
On the index level, it hasn't been that big of a drawdown. When you take a look at an index of meme stocks, it was down 5% yesterday. It's down 17% from the peak. At what point do you think that some of these losses will affect retail appetite and retail psychology, given what a big role they've played, maybe not in the overall total market cap, but certainly when it comes to trading volumes?
Yes, you're absolutely right. The retail investors have been a big buyer of this market. But again, I think it goes back to, reallocating some of those resources to other parts of the market. The meme stock, at the end of the day, it's going to be the earnings that is going to drive this market. And so I think that you're going to see those quality names start to get a bit again. Taking out some of the fraud of the market is a healthy part of the process, Lisa, in our view. We don't want this market to run up too quickly, as we were discussing earlier, is giving those people who have been waiting on the sideline an opportunity. And there is a lot of cash still on the sideline, particularly those institutional investors that has missed some of this rally, that we think that will make up to kind of close that underperformance gap into year end that will come back into this market. But again, focusing on those more quality areas and not sort of the mean non-profitable areas of the market.
Nadia, the government shutdown continues to drag on. Any of this what's going on in the market being driven at this moment a little bit by policy uncertainty in Washington?
I think so, particularly around what it could do to consumer sentiment and what it could do to spending going forward. Reality is people aren't getting paid. And if that weighs onto sentiment, particularly into the holiday season, you could see some pullback, particularly in some of the consumer names. So that is starting to drag on the market on the margin. But I think, as we've been discussing this morning, that as we approach the holiday season, particularly Thanksgiving, you're likely to see the government start to take this a little bit more seriously in terms of what it's doing to the American consumer and reopen the government. I mean, I hear from my mom, who runs our church pantry, that the reality is you're seeing long lines there. So people are suffering, right? And I think that they are calling their representative to sort of reopen this government.
Do you think the government reopens before Thanksgiving?
I do. We do think that it's not a guaranteed look, nothing is ever guaranteed, but it does feel that way, that momentum is building to reopen this government in the next couple of weeks.
Stay with us. More Bloomberg surveillance coming up after this. Investors struggling to reach consensus on the state of the economy, with alternative data sending mixed signals. Priya Misra of JPMorgan writing, "We remained in a soft landing, but I don't see any signs of the economy reaccelerating, and risks are skewed to the downside on the labour market." Priya joins us now for more. Priya, good morning.
Morning.
No payrolls data at 8:30 Eastern time, so we're talking about challenger job cuts. Now, typically we'd ignore challenger job cuts. How much is that data actually worth?
So, a lot of this, ADP, you have to look at the totality of data. I do miss payrolls. Let's spend a second saying it was good data. I just never thanked it before, and now 2 months in a row we haven't had it.
You're starved.
And not just the headline. We have a lot of data. Like somebody asked me the other day, you probably have nothing to do. I said, I have more work because I'm now looking at the totalities. You have to look at ADP, the details, Challenger. We always looked at it, but you had like the king of all data with payrolls, and we don't have that. But we're looking at earnings releases. We're still in that soft landing, and I think that's why the Fed's been cutting, and now the Fed's saying, we need more data. So, data-dependent Fed, data-dependent market is now looking at more creative ways of data. But I think there's a fairly consistent picture of there are these structural positives, right? You talk about the soft landing. The companies are solid, and they're adapting to all these macro shocks, tariffs, immigration. They're managing, and that's why earnings have been rock solid. We haven't even seen the, leverage go up. So it's not as if they're borrowing to make ends meet. The margins are staying strong. Consumer spending is strong, but we have that K-shaped consumer, K-shaped corporate sector, and that's the consistent theme. But the labor market is slowing, and we're still in that low hire, low fire, but how long can that last? As the labor supply grows, people graduate from college,
Sure.
They need jobs. So I don't know if it can last forever. For now, we're in a soft landing. I think owning credit, fixed income's doing what it's supposed to do. So I think, that's how we're sort of positioned.
You mentioned the Federal Reserve. The consensus view of the Fed, at least a month ago, the bias of the Fed, people believed this bias existed anyway, is that they wouldn't deviate from the dot plot, even if they didn't get the economic data. You mentioned the Fed and maybe that view changing. Is that just Austin Goolsbee at the Chicago Fed, or is that the core of the committee now?
I think there is no core. I think there's a huge division at the Fed. And it's not just in terms of risks around the labor market, risks around inflation. It's also on the neutral rate. I mean, I was concerned about this debate that we're having at the Fed maybe 6 months from now. It's happening a little earlier. But if you look at the neutral rate, there are people saying it's 275 and 4. We're right at 4. So I think what Chair Powell said was we need data to tell us which way to lean. I think both sides at the Fed, the division, both are equally vocal. There are those that are highlighting that the labor market's slowing, and then there are those that are saying, well, inflation's still above target, and we don't know what's neutral. Financial conditions are easy, and so you can almost argue, will Fed cuts make a difference? They do make a difference, particularly if that neutral rate is at 3. So I think that reaction function, I think the Chair Powell said there is no clear reaction function. I think there was a slight shift. The data, lack of data, you can tell that the Fed might be in my camp, like starved of data and missing it. So if we don't get data, I think they might even pause. But I do think economic outlook matters as much as the reaction function. We got a sense of a more hawkish reaction function. But if the economic data continues, challenges part of it, if the layoffs start, this is not a job market where layoffs will get absorbed quickly. And I think that's where the Fed then, maybe they don't cut in December, and then they cut more aggressively next year if the economy continues to slow.
I put into ChatGPT, write a poem about non-farm payrolls, and I think it broke ChatGPT because it still hasn't come up with the poem. So hopefully we can get that for you. I am curious, though, do you think that if the Fed does not cut rates in December because of a lack of data, that it will prompt you to want to go into longer-term bonds? That on the margins, it will hamper growth more significantly and tamp down any inflation risk?
I do think if they don't cut and they suggest that this is it, then you can have concerns around maybe long-end bonds. We're supposed to price in a weaker economic outlook. You'll get some froth out of the market. People who've only bought an asset because they think the Fed's going to cut rates, then they start to move away. But I do think if they don't cut, they're still going to keep that put alive, meaning they're going to say, look, if the economy slows down, we're data dependent, we can cut aggressively. This Fed has not been shy under Chair Powell. They've hiked at 75 increments, they cut 50 last year, but they are a data dependent Fed.
How much of an unwind do you expect in, say, some of the riskier assets, whether it's riskier credit or certainly what we've seen with the meme stocks? I know you're not focused on that, but I wonder how much that's in direct response to the idea that the Fed might not be cutting as aggressively and might be closer to done than people had expected.
I mean, there is a lot of liquidity in the system, and the Fed stopping QT was part of that as well. Now, they're not increasing the size of the balance sheet, but I wonder, do people look at the size of the balance sheet growing, which I think is going to happen, either it's December or next year, because of reserves. I think reserves are close to neutral. We talk about neutral Fed funds, we should talk about neutral reserves as well. We're there. So I wonder if, okay, the Fed's not, cutting, but the Fed's growing the balance sheet, so you might get the liquidity staying high, and it can sort of propel more of that. But I think in general, we talked about, remember, cockroaches just not that long ago? I mean, there are excesses in, I would say, every market. And our job is to find them and make sure we minimize the cockroaches, and that requires a lot of credit work, where you have to understand the company. And I think it's people who maybe not doing that might be then at risk of some of that froth coming out, because, we don't know what neutral is. I mean, I think it's closer to 3, but what if it is closer to 4 because financial conditions, liquidity is high? And so you may not get a big decline in interest rates. And that's when you want to make sure you own the companies that don't need lower rates to make their payments.
Priya, you talk about this in your notes. How are you thinking about the risk of what's going on at the Supreme Court in terms of IEEPA?
There was a lot of discussion. I think the bond market got really nervous. And, these are large numbers. If the Supreme Court does rule these tariffs illegal, we're talking 90, 100 billion of tariff numbers. That's a large number. But look at the Treasury has the cash balance has been growing. So I don't see a case where they have to suddenly come out and issue a lot. I think interest rates rose saying the deficit's a problem. The deficit is a long-term problem. I mean, we're at 7% deficit to GDP. That's going to go to 7.2. I think the bond market slightly overreacted. The president, it's the signature policy of the president. He said it's the most beautiful word in the dictionary for him. So if it is struck illegal here, they've got section 122, 232, 301. I mean, I'm no constitutional lawyer, but I think they're going to find ways. It's going to be harder and maybe not as blanket, and Congress needs to be involved. But I think you're still going to get those tariffs. I don't see the tariff number really going down. So I think if the market overreacts, I think that's an opportunity on any Supreme Court headline.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.